Hey, good morning. This is Ralph Mendez, and we're going to talk about Chapter 11 corporations issuing stock, dividends, payment of dividends, purchasing back your stock, who gets the money. All right, so first one, number one, we're issuing stock in this case. Now, first off, why do companies issue stock? Why does a company issue stock? They're looking to expand their business. Uh, they want to raise money for growth and expansion. And again, can be referred to as equity financing because the shareholder gives the company money in exchange for a portion of voting rights and profits. So you own a tiny slice of the assets of that company. All right, so how do we say the issuance of 65,000 shares of $4 par, assuming the shares for $4 each? So 65,000 shares times $4. So what does the company receive when it sells stock, when it does its IPO? It receives cash. And what's credited? The equity. And it's called common stock. Now, and in this case, it's $4 par. So we're looking for $4 par. All right, so there's that. Let's check our work. Answer's not complete. Now look, it's $4 par. What happens if you sell it for $5, right? What happens if you sell for 5? Well, so we still got, so now we sell for 5, and 5 times 65, what is 325,000? So now our cash is 325. But you credit the common stock for the number of shares times the par. Number of shares times the par. Number of shares times the par. So this is still the 260. Well, where does the difference go? You sold it for $1 over par. $1 over times 65,000 is 65,000. And it's paid in capital in excess of par from common stock. So the cash is 325, but you always credit common stock for the number of shares times the par. The number of shares times the par. The number of shares times the par. And I'm going to say it, and some of you, and anything over the par goes to paid in capital in excess. All right, let's try the next second one. Now here we have prepare the journal to record Javante Company's issue of 28,000, assuming the shares have in letter A par value and sell for $15 and a stated value and sell for $15. Well, in both cases, how much cash is raised? 28,000 times 15. So in both cases, it's 420,000. And over here, it's 420,000. Now, what over here? What is, it's only $2 par. So how much is the common stock credited for? It's $2 par. Number of shares times the par, 56,000. And the rest goes to anything above the par goes to paid in capital above the par. Number of shares times the par. 28,000 shares times $2 is 56,000. Now on this one here, it has common stock stated value of $2. So it's still 56,000 and still 364,000 from paid in capital in excess. In this paid in capital is anything above the stated value, but you have to tell it to come from, it comes from common stock. Well, are there different types of stock? Yes, generally though, you probably have common, there's two main types, common and preferred. Common and preferred. So they're both ownership, but this doesn't have the same voting rights. You see how it doesn't have the same voting rights? All right, but they're usually, it's like a quasi debt because it usually gets told that it's, oh, we're going to pay you 4.5% on the par, and if the par is $100, then you get $4.50 per year. Now there is there's, I don't even know what it's worth right now, but there's a Class A and Class B Berkshire Hathaway. I don't know if Class A is like $300,000 per share. So that's why, if you'll notice, the stock symbol is BRK. So the one that's $400,000 is BRKA, and they have one that's way less expensive, BRKB. So within common and preferred, that's the two main types, but some people will customize it and have a different class. All right, so what do we do here now? Let's see, we go on here. Let's go on to number 3. So now we sell for $28, but look what this says, no par common stock. So first off, how much cash do we get? And they sell 74,000 times $28 is $2 million. We raised $2 million cash. Okay, and then what does, because there is no par, let's see if they have, there it is, no par, there is no additional capital. So the whole 2,000,702 goes to there. Now let's see what over here. Record the issue no par, assuming the share exchange for land. So common stock, no par. Where are you? Here we go. And I want you to realize that if somebody's willing to take the stock and give you their land for stock in a company, it doesn't always have to be cash. So if you have someone that wants to sell their piece of land to you in exchange for stock in that entity, you can do it. And that's why I chose this journal entry for you to practice. It doesn't have to be cash. The company could get a piece of land in exchange for their stock. So that's how Time Warner Cable, before they became Spectrum many years ago, 20 years ago, that's how they bought. Oh no, it's AOL bought their Time Warner Cable with stock years ago. So instead of getting cash, they bought a company. Now, I would like to share with you, if you don't mind, you've been seeing par and no par. This is a no par. I'd like to show you a company right here. This is Walmart, and the SEC.gov, and y'all been to this website, and here's the 10K. And if you'll look right here, common stock, par value, how much is the par value? 10 cents. Then here is Exxon. What's the par value? No par. So this problem, this is a real world. No par. And right here, what company is no par? Exxon. What company has a par value of 10 cents? So these are real world problems, homework problems, and things you're doing, All right, let's try number 4. Issuance of common stock. You should be able to do this now. 49,000 shares at $4 par, 317. Well, 317 divided by $49,000, 49,000 shares, you sold it for $6.46 a share. So the cash is the 317. And what is it here? Common stock with a $4 par. Well, number of shares times the par. What's 4 times 49,000? 196. And the difference has to go to the paid-in capital in excess of par. Paid-in capital in excess of par common. Now, what happens the next one? Issues no par. So you should be able to do that, because if there is no par stock, it all goes to the common stock. Cash, common stock, no par. Okay, but you just have to tell the world always where the money came from. No par. Where are you? It all goes there. There's no APIC, no paid-in capital if it's no par. And here, record the issue of 3,300 shares of $15 par for $15,000 of inventory. So in this case, you're buying inventory and you're getting machinery. You're not getting cash in exchange for your stock. So this is a company acquiring assets. All right. So there you go. Now you got to put the values. All right. What's number 5? Journal entry the 4 separate issues of stock. Y'all should be able to do this now. 9,000 par, 4,000 no par common stock, and here is preferred stock. So number 4 is preferred stock. So this is the other type, remember? Some degree of ownership, but usually doesn't come with voting rights, but it's usually guaranteed a fixed dividend forever. So it pays a dividend. So, and if in case it did liquidate, the shareholders are paid off before the common. All right. Okay. So there's, instead of saying preferred stock, cash, it'll say preferred stock. Now, does it have a par? Record age 25 minutes, $75 to $100, $75 par. So there it is. And if it's sold for over that, then it's paid in capital from preferred stock. You see, it doesn't have to just be common stock. It can be preferred. All right. So there you go. Number 6, stock issuance for non-cash assets. So we already said in this case, they're getting land in a building. So they're getting land, they're getting a building in exchange for common stock. And what's the par? It has a $9 par, and then there's paid in capital in excess of par from common. Okay. So instead of getting cash, they're getting assets, common stock, and they got more than $9 per share. 9 times 22 is like 180, 198,000, and they got 362. Okay. All right. Now this is a difficult one. Cash dividend. Oh no. Let's see. Declared a cash dividend payable to common stockholders of $166,000. So we reduce retained earnings. Retained earnings go down, remember, with a debit, just like on the midterm, and it's cash dividends. Cash dividends. No, we want cash dividends payable. Common dividend payable. And then we want, so how much is it? $166,000. So there's our dividend. I make a motion, we declare a dividend of $166,000. And it's going to be to holders of record August 15th, payable August 31st. So the 15th today we declare it. This is whoever owns it on August 15th. So if you sell it between July 15th and August 15th, you're not going to get the dividend. And then you're not going to actually get the money till August 31st. So here on this date, record the entry on the date of the record for the cash dividend. And then what's over here? Record the payment. So here on the record, there's no entry to my knowledge. No journal entry. Then over here, it's just the opposite. Common dividend payable, and you got to pay the cash to the people. Common dividend payable. And it might have been a tough year for some companies. And this is going to be the 166. 166. And let's see how we did here. There you go. We declare it. There's no journal entry. And then we give the people the money here. And, you know, gives us a month here to see who owns the millions in shares, of billions in shares. And then we give it to them then. All right. Now, accounting for a small stock dividend, 11%. So in a small stock dividend, use the market value. Okay. And if we had a large stock dividend, you would use the par. So in this case, this is a hard one, a stock dividend. So it's called retained earnings is still reduced. And then it's common stock, though it's a new thing here. Listen to what you're doing. The liability is very unusual. It's called common stock dividend distributable. And then you have paid in capital in excess of par. Now let's see how we get the numbers. You got 10,600 shares and you declare 11% dividends. So 0.11 times that, 10,600 times 0.11 is equal to 1,166 shares. So 1,166 shares. Well, what are those shares worth? What can they go sell them for? $14. So you're essentially giving them 1,166 shares worth $14 is $16,324. That's essentially what you're giving to the stockholders. Now, but again, the common stock is always, and this is instead of saying it's you use the number of shares times the par. The par is $2. So 2 times the 1166 is the 2332. And the difference is the paid in capital in excess of par. So 16,324 minus the 2,332 is the 13,992. Now, look at what's hard about this. You're not giving cash, you're giving more shares of stock. So if you have 100 shares and you get 11% more, how many more are you going to get? 11. So if you have 100, then you're going to get 11 more. So you're going to have 111. All right. Now over here, you distribute the shares. So this liability goes away. Common stock distributable goes away. I think it was 2332. Is that the amount? 2332. And you actually now give them the stock shares of the $2, right? So here was a liability, and now you actually issue the shares of stock to the people. So you don't give them money, you're giving them shares of stock. Now let's talk about that. In this case, what they're trying to show you here, let's say the situation where there's common stock and there's been preferred stock. Well, what do these people get? They guarantee a dividend. So they're guaranteed a dividend, but the common's not. So let's see if we can calculate out. What's the par value of the preferred? $5. What's the dividend rate? 10%. So 10% of $5 is 50 cents. How many shares are there? 91,000. So how much money do you owe them each year? What's 91,000 divided by times 50 cents? Well, you owe them 45.5. Now, in this case, you didn't pay them last year, so you owe them for 2 years. So then you owe them 91,000. I guess it's $1. 1 year is 50 cents, the next year is 50 cents, so you owe them $1. Now, I make a motion, we declare a dividend 150. So the dividend is 150. How much do you owe the preferred? 91, 2 years. So the common get the difference. So again, how much is the value? $5 at 10%. You owe each share 50 cents. How many shares are there? 91,000. So how much you owe each year? 45,500. For 2 years, you would owe $1. 50 cents and 50 cents is 90. You declare, I make a motion to declare dividends 150. The preferred get the money first, and what's left over is what the common gets. All right. Preferred stock issuance and dividends again. Record the issue of $100 par value preferred stock for 101. Well, how many shares did we issue? Oh, 5,100. 5,100. So how much cash do we raise? And it's preferred stock, $100 par. But it's paid in capital in excess from preferred. Nope, preferred, not par. Paid in capital from preferred. Now look, you notice it sold for $1 more. So $1 times 5,100 shares. So that's going to be, all right. And over here, it's 5,100 shares times $101. So 51,510, and that 5,100 shares is 51,000. All right, so my math's bad somewhere. 5,100 shares times 101. 5,100 times 101 is 51,510, and 5,100 shares times $100 is equal to 5,100 times $100 is equal to, oh, my math's being horrible. Let's try it again. 2 decimal places. 5,100. Am I doing it wrong? 5,100. I need 2 zeros. So is this wrong here? 5,100 times 101. Oh yeah, is 515,100. I knew I had a mistake somewhere. So now we're okay. And in 2, it says the preferred shares times the dividend rate, dividend per share. Well, y'all, what's the par value? 100. What rate do they get paid? 6%. So how much is the dividends per share? What's 6%? 0.06 of 100 is they get 60 cents, right? 10% would be $1, $10. 1% would be 1. So 6, God, I can't think anymore. So it's really $6 they get, sorry. How many shares are there? There's a dividend, 5,100. So 5,100, how much do you owe them? 30,600. There you go. So let's see if we're right. So here, cash, preferred stock, anything over the par, and this is 101, so $1 goes there. $100 par, 6% is $6. Number of shares, 5,100. You owe them 30,000 per year. All right, now what you're doing here is you're just going through one at a time. What are the cash dividends? How much do you give to preferred? So how many shares are there of preferred? Right here, 60,000 shares. So let's see what it is though. It's $5 par. The dividend rate is 8%. So 8% of that is 40 cents. The number of shares are 60,000. So you owe 60,000 times 40 cents. You owe 24,000 a year. But there's one word in here that tells you it behaves differently. Here, it's non-cumulative. Non-cumulative means if they don't have the money one year to pay, that's it. They lose it. The preferred lose it. So if it doesn't pay them this year, it does not have to pay them next year in 2000. So let's just say with COVID, it doesn't have the money to give a dividend. So next year it's non-cumulative, so they don't have to make it up. So if they don't have enough money last year, this year, the preferred just lose out. It's non-cumulative. And one of the problems we had said cumulative, which means they have to pay in the arrears. So in this case, it's 13,200. Pay to the preferred, and the common gets 0. In the next year, they get all of it as well. And their common get nothing, in my opinion, either. I don't understand. I hope there's no dividends and arrears. I mean, there can't be arrears if it's non-cumulative. So let's see what it does. In the next year, they get the 24, and then they'd get the 216,000. And here, they get the 24, and they get 366. So let's see what I'm wrong. Let's see, where am I thinking wrong here? Let's see how much you owe them. 24. So here, 24, you owe them the 24 and 216. 24, 30, 40. Well, I don't think so. I don't think I'm wrong, because that's what you get. They get 24 a year. Now let me just make sure my math. You got $5 par times 0.08 is 40 cents times 60,000 is 24,000. Now, I don't see anything wrong with what I did. You owe them 24,000 a year. You can see it. You owe them 24 that year, and they get the rest. So I have no idea why there's anything in arrears. Because dividend arrears, that's the only reason I could be wrong if they were counting that you owe them the money. You owe them 2,000 in here, but they're not. You don't get arrears. Use the data to determine the amount of dividends paid each year to each of the following. Assuming the preferred, it's cumulative. You see there, they changed it on us. Up here, they said non-cumulative. In here, they want it to be cumulative. So all we got to do, very easy here. If you owe them 24 a year, and you only pay them 13.2, you owe them 10.8 for this year. You owe them that much. And this year, you owe 2,000. So you're supposed to give them 24 and you gave them 22. So you got to do 12.8 now. So in this year here, they get 36.8. And then the 240 minus 36,800, they get 2,032. So now let's check. All right, that's all it is. They set up here as non-cumulative, but for the purpose of the problem, they made it cumulative. So when it's cumulative, because you shorted them these 2 years, you didn't have enough money. They get it in that third year when you finally have enough. All right, a small stock dividend is declared. Does this make retained earnings go up or down? Okay, so when you declare a dividend, it makes retained earnings go down. Small stock dividend is distributed. Small stock dividend is distributed. So you have, it increases it because you could have paid in capital. Treasury stock is sold above cost. It's increasing it because additional paid in capital. Treasury shares are preferred. So here you're decreasing it. All right. A small stock dividend is declared. Well, I guess and a small stock dividend is distributed. Well, the journal entry is common stock is increasing. Stock dividend, you're increasing. But you reduce retained earnings. A small stock dividend is declared. Tricky. The difference between declaring it, when it's declared, it's retained earnings, common stock distributable, APIC. And when it's declared, common stock distributable, common stock. And it wants to know the effect on equity. Yeah. So, is it really no effect? Boy, I'm not understanding the journal entry then. Interesting. State whether the equity would have effect, no effect. I guess it's reducing retained earnings and it's increasing on the other side. All right, let's try treasury stock transactions. We bought our own stock. We're going out and buying stock. So let me just show you this. Here's ExxonMobil. I got to go to page 67 here. Show you the balance sheet. And the reason I chose them is they have the most treasury stock of any company. And this is the first time you see it, so it's not always easy the first time. So let's look at the equity section you've been learning about. Common stock without par. They've sold all those shares and they raised 15 billion. And here's their retained earnings. So there's your equity section. But look here. Common stock held in treasury. That means they've bought back 3 billion shares. They have bought back 3 billion shares. So you see how it has a parentheses? That means it's a debit. And the reason it's a debit is, let me just show you here. If I could show. Here's when you're declaring stock, cash common stock. And here, date of record. And here's a small stock dividend, a large one. But what is happening what's happening when you buy treasury stock? Well, treasury stock, you are debiting treasury stock and cash is credited. So it's treasury stock. I'm just trying to show you the journal entry. See, so when it buys something back, it's using cash. The company is using its cash to buy back its stock. So in our case, in our example, it's buying them back 5,900 shares at $34. So what I'm trying to show you, if you just buy one share, they buy one share, cash is going out. So treasury stock is a debit. So that's why you see it is a debit here in the middle of all these credits. All right. Credit common stock. Remember, cash common stock is credited when you issue it, right? Right up here. cash, common stock, but treasury stock is buying it back. So it's held in treasury. It's not on the market out there in the world. You used your money to buy back. And Exxon has used 225 billion of its money to buy back stock. All right. So now I know that stocks talked about different ways. So let's finish this here. So it's paying $34 cash. So cash is going down. Cash is going down and treasury stock is going up. So 5,900 times $34, 200,600. And Exxon has spent 2,200 billion. So there it is. Now, so it's paying $34. You got to remember you paid $34. So now you sell some for 40. So see, now cash is going up if you decide to reissue it. 12,225 times 40. So it raised $49,000 of cash today, but it paid 34. So you have to credit the treasury stock for the $34 that you paid times the 1,225, 41,650. And now it'll become evident that the difference goes where you raised extra capital. So now you had paid in capital from treasury stock. So you've had three different examples of paid in capital: common stock, preferred stock, and now you have increased capital from treasury stock. All right. So when you sell stock, you could have paid in capital is going up on the credit side. Now we paid 34. Now you sold it for 29. So here the cash you raised is the rest of it. So 5,900 minus the 1,225 is 4,675 times the $29. Let's do that again. 5,900 minus 1,225. So we have 4,675 at $29 is 135,575. And you have to credit the treasury stock because you're not going to own it anymore. So here you have to use the 5,900 you bought minus the 1,225 you sold, 4,675 at the price you paid, $34. So you have to use the 158,950. But look, I'm sorry. They don't match. You need a debit. You need a debit, not a credit. So, and the difference is 2375. But what's the account? Your paid in capital is going down. Paid in capital and treasury stock is going down. Over here, paid in capital went up, but here, 7350. Here it's going down. Now, to be honest with you, if I'm right here, you're supposed to, I don't see if we can, I'm not sure we can use more than the 7350 here. Normally you do reduce retained earnings when you have that much of a discrepancy. You can't reduce the paid in capital by more than what you have. So 158,950 minus 135,575 minus 7350 is 16,025. So let's just see if I'm right here or wrong the way the text handles it. Oh yeah. Oh boy, good thing I caught that. All right, very good. So when the paid in capital was from Treasury was here, so you can't reduce it or get rid of it. Think of a T account. It's credited, so you can't debit it for more than what's in there. So the rest reduces your retained earnings. So they didn't do very well on reissuing their Treasury stock. Now, y'all know, okay, so now how do you figure out if no preferred stock and it's weighted average, what is the earnings per share? So earnings divided by the shares. Earnings, income minus the preferred dividends, if you have some, divided by the weighted average of the shares. Now, and we tried to look at this the other day, both on sec.gov for Walmart or Apple. And then, so remember here, the net income, 572. There's no preferred dividends, 0. What's the weighted average? Remember, we had to take the shares of stock at the beginning of the year, the shares of stock at the end of the year, and divide them by 2. And in this case, and if I'm not mistaken, we figured it was 2.8 billion for Walmart, if I remember right. So, all right. So very good. I really hope this helped you finish this chapter. And corporations are very important. Just so I could show you, when you later on, your choices of entity for your business, think about this. You have sole proprietorship, probably over 20 million in the country. General partnerships, I don't know. Limited partnerships. Now you have LLCs. Now most of these 7,000 publicly traded are C corporations. S corporations cannot have more than 100 shareholders. So again, that's primary smaller entities and things like that. But now you can also have, what's not listed here is publicly traded partnerships. So these are stocks. These are stocks traded, but they're on the stock exchange as well, but they're a partnership. So when you buy money, instead of getting stock, you're a limited partner. And look at the kind of industry they're in: oil, utilities, conglomerates, oil, utilities, conglomerates. There's one leisure. So here are the stock symbols: thermal, coal, marine, shipping. So a lot of energy, chemicals, railroads, marine, oil and gas, real estate diversified, New England Realty Associates. So there are some publicly traded partnerships out there on the stock exchange. All right, there are currently 71 publicly traded master limited partnerships. All right, so I hope this helped you, and you have a great day. Thank you.